Hi everyone. Today we are going to discuss about an important topic in management accountancy for final BCom vocational and general BCom students in 6th semester. That is analysis and interpretation of financial statements. Analysis and interpretation of financial statements is very essential to each and every organization. Analysis and interpretation of financial statements, we gathered a lot of valuable information. Whenever we analyzing the financial statements, automatically we gathered valuable information, that is profit and losses, strengths and weaknesses, financial position, operating profit. So such things we know whenever the data, the financial data are analyzed. Such valuable information we are gathered. So that's why the analysis and interpretation is most useful to each and every organization. So the following methods, techniques are used in studying the financial performance of an enterprise. One is, the 5 methods is available in this. One is comparative financial statements, common size statements, trend analysis, funds analysis, and next one, ratio analysis. Comparative financial statements are 2 types. One is comparative income statement, comparative balance sheet. Second one, common size statements are 2 types. One is common size income statements, common size balance sheet. Next one, trend analysis, fund analysis, and ratio analysis. Look at that. First one, comparative financial statements. The comparative financial statements are 2 types. One is comparative income statement, second one is comparative balance sheet. First one is comparative income statement. The comparative income statement, that means the specimen form of comparative income statement, like this. It has 5 columns. One is particulars, previous year information, previous year data. In second column, third column, present year data. Third column, okay, that means fourth column, increase or decreasing the amount. And fifth one, increase or decrease the percentages. Increase, decrease the percentages calculated, okay, like this. Percentage of change is equal to, this percentage of change is equal to change of amount by previous year amount into 100. Once again I am telling that in comparative financial statements, 2 types. One is comparative income statement, second one is comparative balance sheet. First one, comparative income statement. The specimen form of comparative income statement, like this. It has 5 columns. One is particulars, previous year data, present year data, increase or decrease the amount, increase or decrease the percentages. Okay, increase or decrease the percentages is to be calculated with the following principle. What is that? How we are calculated increase or decrease the percentage is equal to change of amount by previous year amount into 100. So the 5 columns is there. One is particulars, previous year data, present year data, increase the decrease the amount, or increase the decrease the percentages. Okay, first one, sales. sales minus cost of goods sold. Sales minus cost of goods sold. Then finally we got at the gross profit. Gross profit minus operating expenses, the operating expenses. Then add operating income. Then we find out operating profit. Then we find out here operating profit. Next one, less non-operating expenses. Add non-operating income. Then we find out profit before tax and interest. Less interest. Then we find out profit before tax. Less tax. Then we find out profit. This is the specimen form of comparative income statement for interpretation of analyzing the income statement. So, once again I am telling that specimen form for comparative income statement has 5 columns. One is particulars, previous year data, present year data, increasing plus decreasing amount, increasing plus decreasing the percentages. So, the formula for calculation of percentage is change the amount by previous year data into 100. So, sales minus cost of goods sold, then we find out gross profit, less operating expenses, add operating income, then we find out operating profit, less non-operating expenses, add non-operating income, then we find out profit before tax and interest, less interest, then we find out profit before tax, less tax, then we find out profit. So, the following procedure will have to be followed whenever we are analyzing or interpretation the financial statement in comparative income statement. Okay. So, look at the example for comparative income statement. Okay, let us see a simple problem in comparative income statement. Okay. From the following profit and loss account, of X for the year ending 2013-2014, you are required to prepare comparative income statement. Particulars 2013-2014, particulars 2013-2014, amount in 000. Right. Cost of goods sold, selling expenses, operating expenses, non-operating expenses, income tax, net profit, sales, non-trading income. Okay. How we are analyzing our interpretation in common size statement with the following procedure is required. I have already explained that. What is that? Sales minus cost of goods sold, gross profit. Okay, less operating expenses, add operating income, then we find out operating profit, less non-operating expenses, add non-operating income, then we find out profit before tax and interest, less interest, then we find out profit before tax, less tax, then we find out profit. The following procedure is required at the time of preparation of comparative income statement. Once again I am telling that, listen carefully. What is the procedure for analyzing the financial data, for analyzing the financial information in comparative income statement means, first, in comparative statement, the following transactions has to be recorded. One is, first one, sales, less cost of goods sold, then we find out gross profit, less operating expenses, add operating income, then we find out operating profit. Less non-operating expenses, add non-operating income, then we find out profit before tax and interest. Less interest, then we find out profit before tax. Less tax, then we find out profit. This is the procedure we have to be followed whenever the financial information analyze, interpretation in comparative income statement. This is the example problem it is. Okay, look at the answer. Right. Comparative income statement for the year ended 31st December 2013 and 2014, amount in rupees 000. Okay. Particulars, previous year 2013 data, present year 2014 data, increase or decrease the amounts, increase or decrease the percentages. Okay, the following formula we have to be applied whenever we are calculated the percentage. What is that? Increase or decrease the amount by previous year data into 100. Right. First one, as usually, first one, sales. Okay, what is the previous amount? For sales amount is 935, amounts in 000. So sales 935 previous year, present year 129. Okay, previous year 935, 129, increasing the amount here. That's why 1269 minus 935 increase. That's why I am indicated here plus. So plus 334, 1269 minus 935, 334. Okay, 334 by 935 into 100 plus 35.72%. The sales are increased. Whenever comparing with the previous year, the sales are increased plus 35.72%. Next one, cost of goods sold. What is the value of cost of goods sold here? Look at this. 582, 711. 582 previous year cost of goods sold, present year 711. Right. Increasing the amount. That's why I am indicated plus here. 711 minus 582, 129. 129 by 582. Look at that. 129 by 582 into 100. Then 22.16%. So the cost of goods sold increased plus 22.16. Next one, sales minus cost of goods sold. Then we find out gross profit. Sales minus cost of goods sold. Then we find out gross profit. 935, 582, 353. 1269, 711. 1269 minus 711. Then 558. Next one, 558 minus 353, 205. 205 by 353 into 100. Once again, 205 by 353 into 100. Then the gross profit is increased 58.07%. Next, gross profit minus operating expenses. Gross profit minus operating expenses. In this problem, the operating expenses are, two operating expenses are available. What is that? First one is sales expenses is one of the operating expenditure. Second one is operating expenses is also operating expenses to X Limited company. That's why, so first one is sales expenses 204, 360 increased 360 minus 204 plus 156 plus 156 by 204 into 100 plus 76.47%. Next, operating expenses. What is that amount? It is 75, 92. Right. 75 previous year, 92 present year. 92 minus 75 plus 17. 17 by 75 into 100 plus 22.67. The two operating expenses are added here. 75 plus 204, 279. 92 plus 360, 452. Plus 17 plus 156, 173. So 173 by 279. Look at that very concentratedly here. 173 plus 279. 173 plus 279 into 100. Then the operating expenses are increased plus 62.01%. There is no operating income. That's why directly these operating expenses are deducted from the gross profit. These operating expenses are deducted from the gross profit. So, gross profit minus operating expenses, then we find out the operating profit. That is 353 minus 279, 74. 558 minus 452, 106. 106 is increased here. Okay. So, 106 minus 74, 32. Or 205 minus 73, 32. 32 by 74 into 100. 32 by 74 into 100. The operating profit is increased 43.24%. So, once again, gross profit minus total operating expenses, then we find out operating profit. 353 minus 279, 74. 558, 452, 106. 205 plus 205 minus 173, 32. 32 by 74 into 100. So, how much the percentage it is? 43.25%. The operating profit is increased here. Right. Add non-operating income. The non-operating income is available in this problem. Non-operating income, non-trading income, that is called 12, 13. So, add non-operating income to the operating income. 12, 13. 74 plus 12, 86. 106 plus 13, 119. 119 minus 86, 33. 33 by 86 into 100, that is equal to 38.37%. Once again, operating profit 74, 106 plus 32 plus 43.24. Add non-operating income. Non-operating income is 12, 13. 12, 13. Increase plus 1. Plus 1 by divided by 12 into 100, 8.33, 8.33%. So, non-operating income added to the operating profit here. So, 74 plus 12, 86, 13 plus 106, 119. So, 119 minus 86, 33, 33 by 86 into 100, 38.37%. Less non-operating expenses. These are the non-operating expenses. 11, 20. Right. 11, 20. Non-operating expenses are increased here plus 9. 9 by 11 into 100. So, non-operating expenses are increased in this year 81.82%. This is not a recommendable. Right. So, 86 minus non-operating expenses. 86 minus non-operating expenses, 75. 86, 119 minus 20, 99. 99 by 75, 99 by 75, 99 minus 75, 24. 24 by 75 into 100, that is equal to 32%. Next, less interest. There is no interest in this problem. That's why got at the profit before tax, less tax. What is the tax amount here? 27 and 34. 27 and 34. 34 minus 27, that is equal to plus 7. 7 by 27 into 100, 25.92%. Right. Less tax, 75 minus 27, 48. 33 minus 34, 65, 27 minus 7, that is equal to 17. 17 by 48 into 100, that is equal to 35.42%. The profit is increased. Whenever compared with the previous year, the profit is increased 35.42%. This is the calculation procedure. Now, how the data will be interpretation? Okay, look at the problem it is. First of all, sales 932, 935, sales 1269. Cost of goods sold 582, 711. Look at the very carefully here. Both of the years, in previous year and present year, the cost of goods sold is lower than the sales value. The cost of goods sold is lower than the sales value. The increase of the percentage of increase of cost of goods sold lower than the sales value. That's why the gross profit is increased. That is the first point. The cost of goods sold percentage is lower than the sales value. That's why the gross profit increased plus 58.07%. Next one, operating expenses. The percentage of increase of operating expenses. The percentage of increase of operating expenses. So here plus 62.01%. But the gross profit is only 58.07%. That's why the operating profit is available 43.24%. It is gone down. That means operating expenses, it is higher than the gross profit value. That's why the operating profit is available only, the operating profit is increased only 52.64%. Next one, non-operating income. Next one, non-operating expenses. After non-operating income and after non-operating expenses, then so the available is plus 32%. And next one, the profit is available here plus 35.42%. Totally, cost of goods sold is lower than the sales value. Operating expenses is under control. So, the financial position of a company is in satisfactory mode. Because why means here, the profit is increased whenever compared with the previous year data 35.42%. That's why the Excel Limited company financial position is in satisfactory mode. So, this is a simple problem in comparative income statement.